How y'all good people doing? Welcome back to the YouTube channel. And today we're going to be talking about the housing market. Got some breaking news for you guys. But before we get into the main topic of the video today, let me go ahead and ask you guys to do me a favor on a couple of things. The first one is, as you come into the live stream or the video, please right away hit that thumbs up button for me. That's extremely important. So please hit the thumbs up button, because that will allow YouTube to spread this content out to more folks. And I know I ask you this every day, guys, because it's important. If it wasn't important, I would not ask you. So please, as you come into the live stream, or if you're watching it in the video format, go ahead and tap that like button for me. Please tap the like button right away, just to say, hey man, I'm with you. I'm enjoying the content. Yes, we want to get this content out to more folks so that we can continue to build our community and help more and more and more people get to financial freedom. That's the reason I do this, guys. So by you hitting that thumbs up, that's just giving me the green light to continue making these videos, continue putting my time and effort in creating this content. So please hit that thumbs up for me. I really would appreciate that. Again, that's the way YouTube gets our content out to more folks. That's just the way they do it, right? They do it by these likes. The more engagement you have through these likes, that tells the algorithm for YouTube that people like the content, so they should push it out. So hit that thumbs up for me. The second thing I want you to do for me is consider getting up to 12 free stocks from Webull. Webull is going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. There's a link down in the description box of this video. Click on that Webull link. Open up your new Webull account today. Go get that free stock. Go get that free money. If you're going to use paper assets to build wealth, guys, you have to have a brokerage account. And Webull is a brokerage app that I've been using for the last 2.5 years. And it has been really a game changer for me to be able to make my trades in ETFs and individual stocks without having a laptop, without having a desktop. I can do it all from my phone once I download the app and sign up and put money in my brokerage account. Plus, you got fractional share trading for $5 at minimum. And then you got automatic investing. No commissions, no fees. And of course, you'll be using the same brokerage platform that I use. And when I'm using that brokerage app, guys, I'm building wealth. So that's why I ask you guys to consider it. Link down in the description box. I'm going to also send you a Webull tutorial video so that you can have step-by-step basic instructions on how to use that Webull app to buy your first ETF or buy your first individual stock. Once you do your first trade, you'll be a pro, right? You will know how to do it because it's a real simple brokerage app to use. All you got to do when you open the account, fund it, send me a DM on Instagram at RichardFain28. Send me a DM and just let me know you've opened the Webull account, you funded it, and then I'm gonna send you that tutorial video. Well, all right, guys, let's jump on into today's topic, which is the housing market. Specifically, the worst housing market crash in 100 years is here. That's what I've been reading online, guys. Some people are starting to believe that there is a really bad housing market crash coming, followed by 8% 30-year fixed rate mortgage interest rates. That's right, guys. We've hit 8% 30-year fixed rate mortgage rates. 8%, guys. Geez, the last time we've been above 8% for 30-year fixed rate mortgage rates was all the way back to like 1992, guys. I mean, 8%, guys, is humongous. And that's what's fueling this speculation that there is going to be a major housing crash. I can't get my mind around an 8% mortgage. Not when less than 2.5 years ago, you could lock in at 2.5% fixed for 30 years. My sister, my baby sister, bought a house in March of 2021, and she locked in her interest rate for 2.5% for 30 years. Now, 2.5 years later, your average mortgage rate is like 8.39%, guys. That is absolutely bananas. Let me give it to you this way. And here's why a lot of people are saying it's going to be a housing market crash just because of an affordability standpoint, right? Here's the situation. If you were to go out and get a $500,000 loan to buy a house, 2.5 years ago, you could have locked in easily at 3%. Your mortgage payment at 3% would have been somewhere in the neighborhood of $2,100. That's principal and interest. Guys, at 8% on that same $500,000 mortgage loan, guys, check this out. Check this out. Your payment is going to be $3,700. You are talking about a $1,700 difference in mortgage payment. People can't afford that, guys. People just cannot afford that. And that's one of the reasons why you see the housing market, or at least according to some of the analysts and the real estate experts that I've been listening to and reading material online, those folks are calling for a major crash in real estate because of that affordability issue. No one can afford to buy homes. Now, the only kickstand real estate or the housing market has is that we got low inventory. And that's what the other side of the equation, people who are saying, no, we won't have a crash, are pointing to. They're saying it doesn't matter that rates are 8.5% or above 8%. We won't crash because we don't have enough inventory. We have a low supply of inventory to now go with that low demand, right? So normally you would think of a crash where you have a bunch of inventory, you have a bunch of supply, but you have no demand for it. That drives prices down, right? That could trigger a crash like it happened in 2008, where we had this oversupply in the housing market, but we had no demand once the crash happened, right? We had all this inventory though. So you could pick up real estate at a pretty cheap price at that time because of all of that inventory and we didn't have demand. Right now, our inventory, in my opinion, is probably lower than our demand because there is a certain level of a demand still out there. And that demand really that's out there is not dependent upon going to a bank and getting a loan to buy a house. You have a certain number of people out there, a certain percentage of people that can just pay cash. So they won't be affected by this 8 to 8.5 30-year fixed rate mortgage rate. So I can understand on some people's side that, hey, even with the limited inventory, we're not going to have any activity, right? Because if you look at sales transactions, I'm talking about, residential sales transactions year over year. Let's take August 2022 to August 2023. sales transactions have decreased by 15% over that time period. Why is that? Interest rates, affordability. At the beginning of 2023, January 2023, 30-year fixed rate mortgage rates were somewhere in that 6.25 to 6.5, somewhere in that area, maybe slightly lower. Not even a year later, you're talking about roughly 9 months. It's up by 2% basically. Why are rates continuing to go up though? That's what a lot of people are asking, and I know some of you may have that question. Guys, as you're coming into the live stream, please hit that like button for me. I really would appreciate it. We're getting quite a few people in the live, so please hit the thumbs up as you come in, and we're going to continue this discussion about the housing crash and do I believe it's going to happen. But hit that like button for me. I really, really would appreciate it. This is the only way we get the content, spread it out to more folks. The YouTube algorithm requires that we get these thumbs up in order to get this content out. So please do me a big favor. As you come in, hit the thumbs up for me. I really would appreciate that. So let's get back to this discussion about the housing crash. And why are rates continuing to skyrocket? Well, I'm just giving you guys my opinion. Again, guys, you don't have to agree with everything I say. Go out and do your own research. Go out and do your own homework. I'm just giving you my opinion, why I believe what's happening is happening. I'm no expert at this. I'm no housing expert. I'm no analyst for real estate. All I am is a guy who listens, learns, and then tries to give you guys information based on my 25 years of experience buying real estate. See, I'm not like some of the people that come into these live streams and watch these videos, ain't never bought a piece of real estate before in their life, but they got something to say. No, I'm a guy who's owned many properties over the last 25 years. I bought them in good times and bad times, high interest rate environments, low interest rate environments. So I know what I'm talking about when it comes to my experience when it comes to the real estate. Now, I can't tell you when a crash is going to be, but what I can tell you are some of the metrics that go into whether there'll be a crash or not. And that's what I want to talk a little bit about. So what goes into these interest rates? Why are the interest rates going up so high? Well, you got to, you know, the 30-year fixed rate mortgage is closely aligned and tied to something. What is it tied to? In my opinion, it's tied to the bond market. Specifically the secondary bond market, right? So in the secondary bond market, you got these 30-year fixed rate mortgage loans that are being bundled and sold off as an investment. And then you got bonds. Could be corporate bonds, could be treasury bonds, right? They trade, they compete for the same investor in the secondary market. What happens is when bonds on the secondary market, right? I'm talking about existing bonds, when they're priced lower, 30-year fixed rate mortgage rates are priced higher. Why? Because they're competing for the same investors. So our 30-year fixed rate mortgage rate is closely aligned to the bond market, specifically the secondary bond market. But it's also indirectly tied to brand new issues of the 10-year treasury bond, right? So if I'm a guy that says, hey, I'm trying to get, you know, a 5% yield on my money for 10 years, and the U.S. Treasury bond, the 10-year U.S. Treasury bond is yielding, let's say 4.5, and I'm really close to getting that, I may look at that seriously if I don't believe I can go into any other venue and get me a return on my money higher than that. So that 10-year Treasury bond right now, the last time I looked at it, was about 4.6%. But that's for new issue. Think about it this way. If someone already had an existing 10-year Treasury bond at 2%, let's say they bought it 2 years ago or 3 years ago. They bought it 3 years ago and they were going to get a 2% yield for 10 years. That's an existing 10-year Treasury bond. But let's say the brand new 10-year Treasury bond, like I said, is 4.6%. That's a big difference. So for an existing 10-year Treasury bond trading at 2% in the secondary market, you're gonna get below what you pay. In order to sell it, you're gonna have to sell it for less than what you paid for it. Let's say you paid $1,000 for it 3 years ago. You're not gonna get $1,000 now for it because you can get $1,000 brand new 10-year Treasury bond for 4.6%. You're not. So in the secondary market, new issuance of bonds at higher rates hurt existing bonds in the secondary market, which tie into the 30-year fixed rate mortgage, because they're inverse to each other. So when existing bond prices go down, 30-year fixed rate mortgage rates go up. Again, I told you guys they're competing for the same investors. So it makes sense for investors looking in the secondary market, and they're looking between 30-year fixed rate bundled mortgage product investment or a bond. Right now, bond prices are down in the secondary market. So guess what happens to 30-year fixed rate mortgage rates? They are up. That's why you continuing to see them rise. As the Fed increase short-term interest rates, that means typically new bonds, not secondary market bonds, but new bonds, new treasury bonds are going to be priced higher. And when new treasury bonds are priced higher, it hurts existing treasury bonds in the secondary market, which helps mortgage rates go up. That's why your mortgage rates continue to go up, because short-term interest rates are so high. Inflation is still too high, right? The housing market will be impacted by these higher interest rates. Again, the only thing, in my opinion, that's saving it from a real crash is we got low inventory. Guys, if we had more inventory right now, along with those 8.5% rates, yeah, prices would be tumbling right now. And that's the crash I'm talking about. I'm talking about, when do prices come down, right? That's what people care about, prices. Don't get me wrong, there's a certain level of people who care about interest rate too. The majority of Americans care about interest rate probably more so than they do prices, right? They probably care more about interest rate. Middle class Americans making middle class wages, they probably care more about interest rate than they do price, right? Because they can always get a first-time home buyers 3.5% down, right? They can always manage that. The key though is the rate. Like I said, $500,000 loan at a 3% rate. See, and let me give you this quick little analogy. So I got a earner, a middle class salaried earner. I can afford a certain monthly payment. I can only afford like a $2,000 a month payment, right? Now that $2,000 a month payment can afford me a $500,000 house if the interest rate is 3%, right? I can still afford a $500,000 house, but I can't afford the mortgage payment unless it's around 3%. Same middle income earner. Interest rates are now 8%. Same $500,000 house that he could afford just 2.5 years ago. He could afford that $500,000 house because it had a 3% interest rate, $2,100 monthly payment. But he didn't buy it then. He said, no, I'm gonna wait. Prices are gonna come down. You guys, you see where I'm going with this? A lot of y'all, oh, prices are coming down. I'm gonna wait. See? But hear me out. So this guy waits. Fast forward, boom. He goes back and look at that same $500,000 house. And guess what? Can't even touch it with a 10-foot pole now because the interest rate is 8%. Payment just went up by $1,600, $1,700 a month, from $2,100 to $3,700. That's $1,600 a month, guys. That is crushing. And that's why people think that's what's gonna crush the housing market, is because of that jump in mortgage payment. Most people in this country that buy houses, guys, are just average middle class income earner, slightly upper middle class income earners. Those are the people that buy all these houses. And they're not buying houses right now, especially not right now. with interest rates at 8.5%. So yes, the only things, in my opinion, which I disagree with some of the analysts out there, my opinion is the only thing that's saving home prices from tumbling right now is this lack of inventory that we have. If we had more inventory and 8.5% mortgage rates, home prices would be tumbling down. Why? Because at that point, it just wouldn't work. You got too much inventory and prices are through the roof, right? And you got 8.5% interest rate. So for me, honestly, could it be a housing crash? Yes, because anything can happen, right? Anything can happen. But in my opinion, unless you get more inventory or unless something else in the economy breaks, that's the key. Something else in our economy would have to break, right? Something else would have to break. Now, the existing inventory that we have, why is not more of that inventory selling? I think some of it is selling, but people who don't have to go get a mortgage are buying them. You got 65 million baby boomers buying real estate still. See, these people don't care about the price. They got the cash, they got the money, and guess what they're doing? They're still buying. International buyers, people from other countries, are buying real estate here in the United States hand over fist. Why? Because these people got the money and they're trying to take their money out of their country and put it into the US so it could be in a safe haven. And a lot of those people put it in real estate because why? They can generate income from the real estate. They don't live here. They buy really good properties in really good areas, put tenants in them. And why can they make so much money from the rental income? Why? Because your average middle class income earner can't buy a home anymore. And guess where those people are going? They're renting. They're renting these single family homes from companies like BlackRock, from international buyers. They're renting these properties because that's who's buying up all the existing inventory. That's it. That's what's happening. So if you're in the market for a house, you may have no other choice but to wait. Because I don't think most of us are going to be able to afford the monthly payment. Not at 8.5%, you're not. It's going to be really hard. I've already given you one illustration on a $500,000 loan, guys. Go do the math on it. Go run a mortgage calculator on this $500,000 loan at 3% and a $500,000 loan at 8%. Run the math on it. I'm telling you, it's a $1,600 a month difference. How many people can absorb an additional 16? Guys, that's principal and interest too. That ain't taxes. That ain't insurance. If you got to go PITI, oh my Lord, who knows what your payment will be on a $500,000? It'll probably be another couple $1,000s on top of that. So you're talking about a $5,700 a month mortgage payment for a person that's a middle class earner. You can't make it happen. And prices, they ain't coming down because I told you because of low inventory. Matter of fact, prices actually have went up this year, like 6% in certain parts of the country. They've actually went up. Yeah, so the housing market is in disarray for the average American. They can't buy a house. And in my opinion, that's not a good thing, man. That's bad. That's bad for the United States. That's bad for America when people can't even attempt to buy a home. When that's one of the best feelings in the world for someone to achieve a part of the American dream, and that's buying their own home. And they cannot even do that now. Prices are high and interest rates are high. And I know a lot of you folks out there know what I'm talking about. Now, yeah, if you're already in the enjoyment stage of wealth and you've taken care of your money and you've multiplied it and done the things that you needed to do in order to put yourself in a position where you ain't got to worry about mortgage rates, you can just go out there and stroke a check. Good for you. But I would say 99% of Americans can't do that. Can't stroke a check for it. They got to go get a loan. And a lot of them buy a house based on what they can get approved for monthly payment wise. Y'all know what I'm talking about. Same thing with cars. That's what most people do. They look at monthly payment. They don't care how much the car costs. They don't care how much the house costs. What's the monthly payment? That's where most Americans fall in that category. Just tell me the monthly payment. If I can swing the monthly payment, I don't care how much you got to pay for it. Problem is, with an 8.5% interest rate, ain't no making the monthly payment. Because you know, depending upon what part of the country you live in, it's going to be hard for you to find a house. I mean, the average home price in America, average house is like $460,000. So, like I said, that's $500,000. And the mortgage payment itself is $3,700. So my point is, interest rates have doubled, but your salary hasn't doubled. Home prices over the last 3 years in a lot of areas of the country have doubled, but your salary hasn't doubled. When we look at the price of our goods and services that we eat, drink, wear, drive, all of those things have went up significantly in price, but your salary hasn't. Your wages haven't. It don't take a rocket scientist to figure out people are in trouble because their salaries are not keeping up with the cost of living, the cost of housing, the cost of transportation, the cost of food, the cost of gas, the cost of clothing. Your money is not keeping up with it, guys. It's not. Especially when you got to have, I don't know, for some people, I'm going to tell you, man, on a $500,000 loan at $3,700 a month mortgage payment, that's more than people bring home a whole check for the whole month. I mean, even if you're making six figures, even if you're making $100,000 a year, Uncle Sam gonna take what? Uncle Sam gonna take 30% of that. So now you're left with 70. Do the math on it. Okay, take out your insurance, take out your little 401k money that you're putting aside for 401k, all your little deductions. Let's say now you're looking at 60K take home. Guys, that's $5,000 a month. For someone making $100,000 a year, they take home $5,000 a month. How in the world you gonna pull off a $3,700 a month mortgage payment? And that's just principal and interest on a $500,000 loan. You can't do it. See, 2.5 years ago at 3%, you could make it work because that was only $2,100. You're bringing in $5,000. Boy, your DTI is still good enough to get the loan. Right now, your DTI is going to be blown through. You can't make it. You're bringing in $5,000 after taxes, after deductions on a $100K salary. Your mortgage payment is going to be $3,700 a month by itself. Your DTI is going to be damn near 100%. No bank is going to lend you no money anyways. And that's the predicament the housing market is in right now. That's why a lot of people think, God, it's setting itself up for a 100-year crash. It's going to be a historical crash, maybe even worse than 2008. Now, I'm not telling you guys this is what I'm saying. I'm just telling you what a lot of analysts and real estate experts are saying. It's the perfect storm right now that's being created in this country because of inflation, right? Inflation is the culprit to all of this. Because if it wasn't for inflation, guess what? The Fed wouldn't have to increase short-term interest rates. And if short-term interest rates don't increase, your new treasury bonds don't go up as high as they are right now, which does what? It discounts the existing treasury bonds or the bond market as a whole, right? Whether it be corporate bond, treasury bonds, new issuance of bonds at higher interest rates. They cripple existing bonds. Why? Because why as an investor would I buy an old bond at par value when I can go buy a brand new bond at par value and get a better interest rate today? I wouldn't. So guess what? If I'm an existing bond holder and I want to get rid of my investment, I want to get out of it, I'm not going to be able to sell it for par. I'm going to have to sell it below par to make it attractive for someone to buy it on the secondary market. The reason I tell you that is because that's what 30-year fixed rate mortgage rates are tied to. They compete with bonds in the secondary market. And when bond prices in the secondary market are down because of interest rates being high, guess what happens to 30-year fixed rate mortgage rates? They go up. So as long as you see the bond market, I'm talking about the secondary bond market, I'm not talking about new bonds. Because I know someone will say, oh, new bonds are 4 point. I'm not talking about new bonds. I'm talking about bonds, existing bonds traded on the secondary market. When interest rates go up, they go down in value. But guess what? Mortgage rates go up. They are inverse, right? They go the different direction of bond prices in the secondary market. Bond prices down, 30-year fixed rate goes up. Secondary bond prices are up, 30-year fixed rate goes down. That's the way it works. Go out and do your own homework. I'm not an expert at this. I'm giving you my opinion, but I'm telling you that's the gist of it. So if you're tracking interest rates or 30-year fixed rate mortgage interest rates, it's probably a good idea to go out and track bond prices on the secondary market, because they're going to tell you what mortgage rates are going to do. And right now, if you go on the secondary market, your 10-year treasury bond, an existing 10-year treasury bond, is going to trade lower than a brand new treasury bond, because the brand new treasury, 10-year treasury bond, will have a better interest rate. Why? Because the Fed is raising interest rates. Plus, banks. Think about banks. Think about this. If a bank has, let's say, $5 billion in cash that they got $5 billion in deposits. Let's put it this way. Let's say some bank has $5 billion in deposits that they're trying to decide what they want to do with it in order to make money off deposits, right? We can lend this money out to folks to borrow from us, right? Or, which carries a level of risk, right? Or we can just go simply to the U.S. government and do a bond with the U.S. government, and it's guaranteed. Now, here's the rub, though. Let's say they want to go out and get a 10-year treasury bond. I told you a brand new 10-year treasury bond is trading about it has an interest rate that's about 4.6%. It represents no risk to the bank. Why? Because it's guaranteed by the full faith of the United States government. It's guaranteed. They're going to get that 4.6% for those 10 years. Now, if they go over here and look at you and I, and they say, well let's take the $5 billion and consider doing some mortgages. They're not going to give you they're not going to accept a 4.6% rate like they're getting from the U.S. government that's guaranteed to them. They're going to charge you more because you pose a more of a risk of default. You're not the U.S. government. I'm not the U.S. government. So they're going to add premiums to that rate. All right? So if I got $5 billion, if I'm a bank and I got $5 billion and I'm finna lend this money out for mortgages, I'm gonna charge it probably 4 or 5% higher than what I could get guaranteed from the federal government. Why? Because the federal government money will be lower, but it's guaranteed. If I'm gonna take the risk of lending money to people who may not pay me back, they get fired, they ain't got no savings. You know, in America, we ain't got no savings. Our savings rate is down from $2 trillion down to about 190 billion. So we got no savings. We already know 61% of Americans live paycheck to paycheck. We already know that. That's statistic. That's proven. So when the bank is looking at what they should do with their money, they're saying, well, okay, we can lend it to these people over here that are 1-2 paychecks from being financially destroyed. If we lend them the money, we're going to lend it to them at a higher rate than we can get from the U.S. Treasury on that U.S. Treasury bond. We can get a 4.6% rate on that U.S. Treasury bond, but we're going to charge these guys 8%, 8.5%, because they pose more risk. They're probably more prone to default because, one, their savings ain't there. They don't got an emergency fund. 100 million Americans got no retirement savings. So when banks lend money, guys, they look at all of that. See, they look at it on a national level, and they do a risk profile of any loan that they do, or any group of loans that they do. They do a risk profile, and if that risk profile is riskier, they charge you more interest rate. That's the way it works. People are out here to make money. Banks too. Same thing on the bond market, right? Same thing in that market. When you're talking about 30-year fixed rate mortgages are bundled together, guys. It's not like one mortgage. It's like a ton of them. They're all bundled together and they're sold off as an investment in order to get people to buy what do you think Fannie Mae and Freddie Mac does? They bundle these mortgages and they sell them off to investors. And an investor, if they're going to take on more risk, they want a higher return. The investor says, well, Fannie Mae, Freddie Mac, or whoever else is selling us these bundle of mortgages, why would we take these bundle of mortgages at 5% when I can go get a U.S. Treasury at 4.6? They wouldn't do that. So guess what? To make it attractive to investors, you got to increase the rate, commensurate with the risk. So that's the reason why rates are high as they are, guys, in my opinion. It has to come down to investors and what investors are willing the risk they are willing to take, but you got to pay them to take that risk. That's what you're running into. So anytime these U.S. Treasury bonds are trading higher, I'm talking about brand new ones, not the ones that are already existing, but brand new ones. Anytime they're trading higher, guess what? Mortgage rates are going to go up. Anytime the existing bond market is trading lower, guess what? Mortgage rates go up. So keep your eye on what's happening with inflation. See, inflation is really the culprit, like I told you earlier. That's really the main reason all of this crap is happening with our economy, including the housing market, including the stock market, including some businesses. The main reason a lot of people are struggling and a lot of businesses are struggling, the country is struggling, is because of inflation. See, when inflation is high, it's not at the target percentage, which is 2% the Fed wanted at. It's not there yet. Right now, like I said, the core inflation is still, 4.3%, I believe? And I believe headline is like 3.7. Guys, core inflation needs to be under 2% before the Fed is going to feel comfortable bringing down short-term interest rates, which in my opinion does what? Those short-term interest rates affect the 10-year Treasury bond. And I think indirectly, this is my opinion, indirectly, the 30-year fixed rate mortgage is tied to that. Normally at about a 2% to 2.5% spread off of the brand new 10-year Treasury bond. It's a little bit higher today, though. I'm not talking about the secondary bond market at this moment. I'm talking about new Treasury bonds being issued, 10-year Treasury bond. It indirectly affects 30-year fixed rate mortgage rates. So watch what's going on in the secondary bond market, right? If prices of bonds start going up in the secondary market, interest rates for 30-year fixed rate mortgages are going to start coming down. That's what you got to watch. You got to watch the secondary bond market. That'll tell you. And right now, the secondary bond market is hurting. They're falling in prices. Why? Because new bonds being issued are more valuable to investors. They pay a higher interest rate. Why in the hell would I want to go buy an old bond when I can buy a brand new one at a higher interest rate? You ain't got to be a rocket scientist. If I'm in the market to buy a U.S. Treasury bond, and if I can get a brand new one, now it may be trading a little bit above par. It might be. I don't know. But all I know is if the interest rate is double what an old one is, I'm gonna take the new one, even if I gotta pay above par. That's okay. I'm gonna get a higher interest rate. So that's what you got to keep in mind. You got to just continue to watch what's happening in the secondary bond market and continue to watch what's happening with interest rates and inflation. That's why I tell you guys, pay attention when the Fed chair gives his comments. Now, those comments don't mean that's going to be exactly what's going to happen, because he's just giving you forward guidance, right? Forward thinking. That can all change whatever when they get data in. Like I said, we got a September CPI inflation report that's going to be coming out in a week or so. Maybe in a week or so, yeah. And then we'll have another inflation report. Well, we won't have October's inflation report before the Fed meets again, but you'll have the September one. That data right there is gonna shed some light on what we can see the Fed do in their October 31, November 1 meeting. More than likely, people are saying they're gonna probably increase interest rates by 25 basis points more, just to try to stamp out inflation. Like I said, inflation has been a problem. It's been a problem for the last couple of years, man. It's been a problem, and it's really hurting the housing market. Not in the sense that home prices are going to come down, because home prices are not going to come down because we don't have any inventory. But when I say hurting the housing market, is because your average American cannot afford to buy a house anymore. Can't afford it. Not with 8.5% interest rates, and not with sky-high prices. You can't do both. See, most folks don't mind the high price if they can get a low enough interest rate to make the payment work. But you can't have a high interest rate and a high price of the house. You can't make both work. Like I told you, most people look for payment. They don't worry about the price. Fit me into a payment. Here's what I can afford payment-wise. Here's what the bank says I can afford. I can afford $2,500 a month, so go find me a house in this neighborhood where the payment is going to be $2,500 a month. That's how most people shop for houses. Most middle-class Americans shop for houses that way, just like they do for a car. It's all about payment. It's all about interest rate. So I can see where some of the real estate experts are saying this crash is coming. But I don't believe it's coming, because I don't think it's coming because of the low inventory, right? And I think you got enough activity. Even though sales transactions are down by 15% year over year, you still have enough sales transaction for the existing inventory to keep prices high. And I told you where those sales are coming from. They're coming from baby boomers, 65 million of them here in the United States, right? They're coming from international buyers, and they're coming from companies like BlackRock. That's where they're coming from. That's where a lot of these transactions are starting to happen and come from, of the existing inventory that we have. When people are willing to put their house up for sale, most people are not willing to put their house up for sale right now. And the reason they are not willing to put it up, because these people are saying, why in the hell would I give up my 3.5% fixed, 30-year fixed rate mortgage for 8% fixed rate mortgage? No one will do that, guys, unless they're forced to. They're not going to do it. I wouldn't do it. And I know there are other people out there that are saying the same thing. There is no way in hell I'm going to switch out my 3.5% fixed for an 8% fixed. Doesn't make any sense. So those folks who could potentially be sellers sitting on the sideline, and they're saying, hey, we'll just wait. And ain't much inventory coming on the market. Why? Because why would a national home builder want to assume all the risk of building all these spec houses with nobody to buy them? You know who national home builders depend on who as their buyers? Middle-class Americans. Not the upper middle class, not the upper 1%. That's not who national cookie cutter builders depend on to buy their product. They depend on normal, everyday Americans, not minimum wage, but middle income to upper income Americans. That's their bread and butter. Not the 1%. See, the 1%, they're going to buy regardless, and they're going to custom build. They're not going to need a cookie cutter national builder to do anything for them. They're going to go in the area they're at and find the best custom builder and custom build their house and pay whatever they want to pay. Why? Because they built wealth. See, they built wealth. They made money, they kept it, and they multiplied it. So I preach this to you guys every single day, this financial message of, guys, you got to make money, you got to take care of it and keep it, and you got to multiply. That way, you got choices in your life. You got freedom in your life. You got more time in your life. But if we don't do all of those things, then we're going to be subject to whatever happens in this economy. Interest rates go up, well, can't buy a house, can't afford it. Can't make the monthly mortgage payment. Can't do it. Oh, got to cut back on this, got to cut back on that. Why? Can't afford it. Now, some of us, we just throw that out the window and go to our credit cards. We go right to the credit cards to be the safety net. Guys, if you're coming into live, hit that thumbs up button for me. I really would appreciate it. Hit that like button. Just tap the like button. That really tremendously helps the YouTube algorithm pick up this content and spread it out to more folks. I really would appreciate that, guys. Again, you don't have to agree with everything I say, but if you enjoy the content, you frequent the content, all I ask you in return is to tap the like button. I really, really greatly would appreciate that. It goes a long ways. I love the idea of helping more people get to their financial freedom. And again, guys, I'm no expert here. I'm not trying to come off as an expert. I'm just a guy who invested in real estate, 1 to 4 family, for 25 years. I bought a lot of real estate in good times and in bad times. And I'm telling you, right now, where interest rates are, I've never experienced this in my 25 years of buying real estate. Not above 8% for a fixed rate 30-year loan. I've never experienced 8% interest rates. And I know just by doing the math, the quick math, it's horrible. It's horrible for the housing market to have rates this high. Coupled with low inventory, which is propping up prices. It's not where we want to be in this country. It's not where the Fed wants us to be, but they have no choice. Because if they don't keep increasing short-term interest rates, we'll never get inflation down. We'll never get it down. Like I told you, when they meet in late October, early November, they'll be meeting. It's widely expected they're going to increase short-term interest rates again. What does that do to the 30-year fixed rate mortgage rate? I don't know. But I guarantee you, I'm going to go look at the bond market. The secondary bond market will tell me exactly what rates are going to do. In my opinion. That's just my opinion. I think the secondary bond market is the place you got to be looking at to get an indication on what's going to be happening with your 30-year fixed rate mortgage rates. I've already explained to you, in my opinion, again, just my opinion. You guys go out and do your own research. I've already told you that the bond market, the secondary bond market, and 30-year fixed rate packaged loan products compete for the same investor. They compete for the same investor. So when bond prices are down in the secondary market, interest rates for 30-year fixed rate mortgages are up. Why? Because now if I'm a company that packages 30-year fixed rate mortgages, and I'm competing for the same investor, and the bond market is down in the secondary market, it's pretty easy for me just to raise my interest rates, and now I can get those investors. I don't have to compete with the bond market in the secondary market because their rates are lower. Their prices are lower. I can increase mine. I become more attractive to an investor now. And that's the reason why your 30-year fixed rate mortgage is going up. People are out here making money, man. Don't get me wrong, inflation is a big part of it now. I told you that already. Inflation has a lot to do with it. But that doesn't mean because we got high inflation, people ain't out here capitalizing on it, guys. That's what I try to tell you guys every day. People are out here capitalizing and getting wealthy in this volatile environment that we're in. They're getting wealthy because they know how. That's no different in the 30-year fixed rate mortgage world, right? That's no different. Investors are buying packages of these mortgages. I'm talking about 1,000, 2,000, 5,000, 10,000 mortgages bundled up into an investment. And in order to sell that 10,000 packaged up mortgages, you're going to have something that's attractive from an interest rate standpoint to compete with what? A brand new bond, right? Not the secondary bond, but the brand new bond, right? If I got a brand new bond, like I said, 10-year treasury bond, trading at, interest rate 4.6 guaranteed, but I want to attract these investors, and I'm a mortgage bundler, right? I'm a mortgage bundler. The only way I beat that is I got to give them a higher rate to beat the government's rate on the treasury bond. And that's what you see happening with the rates. That's why these rates are continually high, because it's all about this. People taking advantage of interest rates being high. They're taking advantage of inflation being high, and people are just getting wealthy. All I'm telling you, when we break it down to folks like us, your normal, everyday person trying to build wealth, why can't we take a part of those opportunities as well? Go find you an ETF out there that bundles these, that has all these bundled mortgages in them. There's ETFs out there for that. I don't know. Hey, if you're demanding those type of rates, those bundled mortgages at this point must be making a bunch of money. Now, I don't know what the underlying collateral looks like, because your bundled mortgage package is only as good as the mortgage the person who actually bought the house and got the mortgage. You got to have good credit-worthy people in that bundled mortgage package. But I got to believe you do, because of the stringent guidelines that these banks are taking people through now in order to get a mortgage. You can't just walk in there like you used to back in 2008 and just blow into a breathing tube and if you're alive, they gave you a mortgage. They ain't doing that no more. They very stringent now. So all I'm telling you is that might be an investment opportunity for some of us. Go grab us an ETF that has these bundled mortgages in them. Might be a decent ETF to have in a portfolio. Also, with these interest rates being as high as they are, it also has forced the stock market, downward pressure on the stock market. There's another opportunity for us right there. Maybe I'm sitting on the sideline and I can't buy a house right now. And that's a lot of us. We're sitting on the sideline because we're priced out, whether it be interest rate or home price. We're priced out. We cannot buy a home right now. We're renting, living with parents, living with friends. Who knows what we're doing? All I'm telling you is while you wait till all of that stuff to correct itself and right size itself, while you wait, you should be investing in assets to build you some wealth. You got the extra money. Now, I'm not saying take your down payment money and bet it all on black. I'm not telling you that. What I'm telling you is, if you have a primary salary, and let's say your primary salary right now, you could afford a house for $2,000 a month, $2,500 a month. But unfortunately now that's doubled, almost doubled, right? Because the rates then went up to 8%. You can't afford that anymore. So let's say you're renting a place. Let's say you're renting a place for $1,800 a month or $2,000 a month, but you got an extra $500 left over from the previous mortgage you could have afforded if you would have pulled the trigger, but you didn't. But you got $500 left over. Your budget for mortgage payment was $25. Your rent is $2. You got $5 left over. Why not take that $500 and start putting that in something to build wealth? Why not do that? Why not take that $500 extra that you have in your budget for your mortgage payment? You're paying $2,000 for rent. You would have paid $2,500 for a mortgage payment, but no longer can get a mortgage because it's too pricey, right? It's not affordable anymore. Take the $500 and start buying some assets. Start looking into buying some paper assets, like the S&P 500 ETF that tracks the S&P 500 index. Look at that. You can get a nice return, right? You can make that $500 a month do some work for you. And all you got to do is do that until things get better in the housing market. Do that until things get better. It's better than taking that extra $500 and making somebody else wealthy, because that's what most of us are doing. Well, can't afford to get a house now. Rates are too high. Should have pulled the trigger a couple of years ago when rates were in that 5.5, approaching 6%. I could have probably still wiggled that one through the bank, but at 8%, it's a dead deal. So, hey, I guess I'll go ahead and just, take up golf and go buy me $1,000 pair of golf clubs and go out here and play me some golf until no, that's not what I would do. What I would do is I'd take that $500 and start putting it into an asset that can multiply it for me. And that's what most of us should be doing. Because believe it or not, guys, really the people being hurt by this whole thing in the housing market are not the 1%. They're not hurt whatsoever. They're not hurt whatsoever because a lot of them, they pay cash or they have such great relationships with their investment bank or their main bank. They can go in and say, hey, you got all my deposits. Give me a CD loan. You pay me 4 or 5% interest on that CD loan. I'll pay you 6.5%, 7% on the loan. But net, I'm securing it with my cash. You're going to pay me 4.5%, 5% on my cash. I'll turn around and pay you 7.5% on the mortgage because guess what? Net, really, I'm only paying you 2% because you're backstopping me with a 5% rate on my money market, on my CD, and this is the same money I'm collateralizing to get the loan. See, that's how these rich people, wealthy people do. They go to the financial institutions where they got all their money at, and they use that money as leverage to get deals done when normal people can't do that. See, they'll walk in there and say, hey, I got a couple million with you guys in my investment account or sitting in my money market. Guess what? I've identified a property that I want to buy for $1 million. I got $2 million with you guys. But listen here, guys, none of that funny stuff. I'm not finna do no regular 30-year mortgage where you can beat me over the head with an 8% rate and I get nothing. That's not what we're doing. This is how we're gonna do it. You're gonna take $1 million of my $2 million and you're gonna secure a loan with that $1 million. But in order to secure that loan, you're gonna have to pay me the same interest rate you're paying me on my high yield money market, which is 5%. You pay me 5%, I collateralize my loan with my money, and then I go out, you give me a check and I'm gonna buy my new property, I'm gonna own it free and clear because your collateral is not gonna be the property. Your collateral is gonna be my money in the bank, which is a better deal for the bank anyways, right? Cash or some piece of real estate. Bank rather take the cash because it's easily accessible to them if someone goes rogue and don't make their payment. They ain't got to foreclose on the property. They ain't got to go through all these hoops of suing you. They just go in and take the hold off of that $1 million. Boop, it's gone. That's what rich people do. That's what wealthy people do. They leverage their investments and their cash to avoid paying these high interest rates, right? That's what they do. But for 99% of us, we don't get that luxury because we haven't built wealth. We've spent most of our time making money, spending it to make the 1% wealthy, and the 1% know how to use the financial system to their advantage. So we got to change and reprogram the way we think, guys, if we want anything to change in this financial life for us. The housing market is just one of the issues for middle-class Americans, 99%ers. It's just one of the issues for 99%ers, right? It's just one of the issues. Everything is increasing in price right now because inflation is high. So my thing is, discard all the things that you don't need, take your money and start building wealth right now so at some point in the future you can have some choices like the 1%. Because right now the 1% have all the choices. They have all the time. They have all the freedom. And for us who have not built wealth, we don't have any of that. We got less time. We got less freedom, and we have less choices. You got to reverse that. You want more of those things, not less of those things, especially as you get older. You get to be my age, you're going to wonder, golly, wouldn't it be nice? Wouldn't it be nice if I could just spend the day in my garden and not have to worry about working? Wouldn't it be nice if I could just spend the day with my grandkids or spend the day with my grown kids? Wouldn't it be nice? Wouldn't it be nice if I can just build me a little art studio in the house and I can get in here and chase that dream and that passion I've always had of being an artist. But right now I can't do any of that because I'm stuck working for somebody. Because I didn't plan and I didn't prepare financially, so now I'm paying the price for it. Guys, there's no way we should be living. Nobody should be living that way. None of us. But unless we change something in our financial life, that's what we got to look forward to. I'm telling you, that's what you got to look forward to. So please, take heed. This may not be a bad thing that the housing market is in bad shape for most of the 99%. The 1%, it's perfect. For 99%, it's in bad shape because we can't buy a home. But that's not always a bad thing. Sometimes stepping back, redirecting those dollars elsewhere that you would be spending on down payment, you'd be spending on a big old mortgage payment, redirecting those dollars somewhere else for a time and let them multiply. And then when things with interest rates get better, and they will at some point. I don't know if home prices will ever come down like they were prior to the pandemic. I don't believe they ever will. But I think interest rates will definitely come down. They will definitely come down. I told you the last time interest rates were above 8% for fixed rate 30-year mortgages was, I believe, around 1992, 1994. That was the last time. Last time they were that high. So all I'm telling you is at some point they will start coming down. Nobody knows when. All I can tell you is watch the bond market, the secondary bond market. And if the secondary bond market prices start going up, right? If they start going up, guess what that tells us? Interest rates are coming down. That's what it tells. Because why? New bonds will be trading lower than existing bonds. See, when interest rates come down, new bonds trade lower than existing bonds. So therefore, existing bonds are priced higher. When that happens, mortgage rates come down. See, mortgage rates are going to be lockstep with interest rates, the Fed funds rate. They're going to be indirectly affected, but they're going to have a spread, right? So Fed funds rate is what? 5.5%? And now we got interest rates what? 8% on average, 8.39, some in that area. You see what I'm going with this? So guess what? There's a spread between those two. Maybe a 3% spread. So if the Fed funds rate goes down to, let's say, 2%, let's say it takes a 3.5% dip in the next year and a half, 2 years, and it gets itself down to 2%. That means mortgage rates will probably be under 5% when the Fed funds rate gets to around 2%. Think about it. January of 2022, Fed funds rate was 0. What could you get a mortgage for at that time? 2.5%, 3%, right? So is there like a 3% difference between the Fed funds rate right now and the mortgage rate? Now, it's not always a 3% difference, but I'm just trying to give you an idea of when you start seeing short-term interest rates come down, typically your 30-year fixed rate mortgage is going to be 2 to 3% higher than that. So if the Fed funds rate gets down to 2% over the next 2 years, you can look at mortgage rates being in that 5% range. That's the way you look at it. If you see Fed funds rate over the next 3 years, let's say 2026, everything's great. Inflation is under 2%. Fed really happy with it. Fed fund rate goes back to 0 again. Then you can look at mortgage rates probably being around 3.5, 3. That's not always exact, guys. I'm just giving you just something to sort of watch, to give you a barometer of kind of what's happening. That's what I do. I'm not saying that's scientific and it's always going to be accurate, but if you look at the data, if you look at the numbers, look at, like I said, look at when the Fed funds rate was 0. Look at what interest rates were for 30-year fixed rate mortgage rates. Just go take a look at it. Go do a little history, a little research, and look at that. I think they keep that 2 to 3% spread. That's my opinion. And that's what I'm going to be watching. Also, I'm watching the bond market. So keep that in mind. Well, guys, I appreciate you hanging in here with me today. I think I'm going to leave it there. Before I get out of here, though, you know I got to ask you to do a couple of more things for me. Number one is hit that thumbs up button. I know a lot of you have already hit that thumbs up button. Hit that like button. Please hit it once more before you get out of the chat. Please hit the like button, guys. It helps the YouTube algorithm pick up this content and spread it out to more people so that we can grow our community and help more people get the financial freedom. That's the whole point of me doing these videos, guys, is to try and help more and more people get the financial freedom. So please help me out. Help me in that journey to help more people by hitting that like button. Please hit that thumbs up button. It's extremely important. Hit it, hit it, hit it, and hit it again. I really would appreciate it. Thank you so much. Also, share the video. You know, share this video with somebody in your network, in your family, in your neighborhood, somebody that you go to the gym with, somebody you go to church with. Share it with somebody who may benefit from just getting a different perspective on what's going on in our financial world. Again, it ain't the only perspective. You may not agree totally with the perspective, but it is a perspective for someone who's been in the financial arena for 25 years, actually doing what he's talking about. Not just, oh, I just read about it and this is what, no, I've actually been in the real estate market in both good and bad times. High interest rates, low interest rates. Bought real estate in both environments and did extremely well. So I have a level of experience when it comes to the real estate, the housing market. So share the video. I really would appreciate it. Also, if you want up to 12 free stocks, there's a link down in the description box to get 12 free stocks, up to 12 free stocks from Webull. When you open a new Webull brokerage account, put any amount of money in that account, they're going to give you up to 12 free stocks for just trying out the brokerage app. So link down in the description box for that Webull offer. Go get that free stock. Go get that free money. I'm going to also send you a Webull tutorial video. All you got to do is DM me on Instagram at RichardFain28 and let me know, Richard, I've opened the Webull account. I've funded it. And then I'm going to go ahead and send you that tutorial video, which will give you step-by-step instructions on how to use the Webull app to make your first trade so that you can start building some wealth immediately. Thank you guys again for stopping by, tapping in. I recommend you tap in every day because y'all know I'm going to be out here every day doing the same old, spreading that financial gospel. That's what I do. That's what I love doing. I'm going to continue doing it till I can't do it no more. So if you're subscribed, thank you. If you're not subscribed and you'd like to subscribe, hit the subscribe button, man, and join this movement. Join the movement. Get yourself to a point where you got some freedom in your life. You got more choices in your life. You got more time in your life. Because I know most of us don't have enough of those three things, and we want more of it. So join this movement to get these financial tips to get you there. Thoughts become things. You can see it in your mind. You can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video or the next live stream. Peace.